Hello traders, this is Blake Morrow and you are listening to the week ahead video for February 11th, 2018. I want to welcome you guys and gals for for being here, but thank you for being here. And I want to thank you guys and gals that also voted for us for the FX Street Award for Best New Contributor. That award or the winners of those awards will be actually announced next week, I believe next Friday. So excited to hear what happens, but I want to thank you guys and gals for all the support. Before we get started, I've got to mention, if you haven't signed up for Forex Analytics, you should try it. It's only $1 for 10 days. $1. But once you do that, make sure you download the mobile app. And then get it from the App Store or Google Play Store. You get all the notifications and updates right to your mobile phone. Look, I've got kids' sports like crazy in the evenings during the Asian markets, and it's nice to have those, those alerts coming when support levels have been breached or resistance levels have been breached. The market starts moving, and being on a mobile device, it's easy to trade from. To execute a trade, it's not so easy to make analysis. So having Forex Analytics there and being able to look at the charts as things develop is really important, at least for me, and I'm sure it is for you guys too. So anyway, make sure you try out Forex Analytics, because once you do that, you'll log into the overview screen. What you see here, we call it the traffic light page. And before I get into what's going on next week, I want to talk a little bit about, obviously, the big and I've been using the term elephant in the room a lot recently, but really this week and last, I got to talk about the S&P, and I'm gonna bring up a familiar chart here that we talked about the last couple of weeks. And this, it's interesting. We saw the S&P hit the AB equals CD, or at least near-term peak at about 2,900 in the S&P, and then we reversed quite aggressively. So you guys have been familiar with this chart and this equal move here. You can see it right here. That equal move from the 2000. This is the spike low following the flash crash, which was over here a few months before, and to the highs in 2015, and we basically completed it as far as in price, but not necessarily in time. But the more important thing is that we actually had a really big reaction, and if you see the daily chart, this shows you how aggressively the market is sold off this last week. Now, I want to warn you guys and gals, for those of you that trade equities, the moves are quite violent right now, and it doesn't seem like volatility is really going to subside. It may temporarily for a week or two, but this volatility might be here to stay the beginning of this year. So you got to be really careful when you're trading equities in any way, shape, or form, especially if you're trading some of these indices, or if you're European or Asian, you have some ETNs that you're trading. Just be very careful. I would suggest that you take a little bit smaller positions, because the volatility is so high. This way, it helps you reduce your risk in case you're wrong, and in case your stops get broken, and triggers a loss. It doesn't hurt as bad. You want to take smaller positions when you got this huge volatility. Okay, some big developments here, though, I've got to point out. First and foremost, that you might have noticed that the January move that we had from is actually the end of December, the last couple of trading days of December before the new year. All the month of January, we actually extended 161% extension, and we also hit the 200-day moving average. Now, this is Trading Views, this is FXCM. This is their ETN, but which is basically like the S&P futures. It's a very similar. It's almost identical to looking at a continuous S&P future contract, and that's why we use it. I'd rather use a futures contract or something that's more continuous rather than the S&P cash market, because you can see what has happened in European Asian trade when a lot of these when a lot of volatility is happening. not just the North American markets during the cash trade. So, but anyway, you'll notice that we tagged the 200-day moving average on the ETN. Now, if you look at the cash market, we didn't quite reach it, but again, this is it shows the significance here. We also hit the channel low. And we stalled, and this is twice. Okay, so it's happened 2 times this last week. Now I'm going to take you over to an intraday or a 4-hour chart, because I want to show you the aggressive bounces that we've seen and what might happen here. And the reason why I'm pointing this out, I know you guys are mostly currency traders, but because it could influence what we do as forex market traders, especially those of us that trade the dollar predominantly. And if you didn't read the article on our blog about the US dollar and the S&P that I wrote, make sure you read that. You'll notice if you go to our site and you just go over to the home page, it's in the blog section right here, and it's just going to be the last blog that was just written, which just says S&P may have peak near term, but what does that say about the US dollar? So you can read more about my thoughts here. But it's important because what happens with the S&P might really influence us. So I think one of 2 things are going to happen here. You're going to have us reject. You notice this is a wedge. You can see this is like a possible wedge, but we had such a big reaction on Friday. What I'm thinking is going to happen is we're going to get a rally coming out of this early next week, and then we might turn lower. Or, you also have to keep in mind that a lot of wealth has been lost this last 2 weeks, and that might have put in a little bit of panic in the the wealth effect is starting to diminish here. And I mean, we've seen a pretty big move, whatever it is, let's actually figure that out from the highs. You're talking about a roughly, 11% move in stocks in the broad market. So, if you have somebody that has, like, let's say $1 million in their retirement account, and now it's 900,000, that's a big chunk of return that has been lost. And so the longer that we hold these levels down here, the more panic-stricken the big money might become. And so if we don't get a recovery, I wouldn't be surprised. But I think you got to prepare for either a move, move a little bit higher out of the S&P, maybe back up to, back up above 2,700. But if this wedge holds and these lows break, the S&P is going to be making another leg lower sooner rather than later. I think it's more of an eventual move that we're going to see is going to be lower. I just don't know if we're going to go higher first then lower. The reason why that's important is because the dollar index. The dollar index has recovered off of pretty key support. We see 127%, or excuse me, this would be a 127% extension of this move here. And I'll actually, I believe it is. Let's go ahead and 127% extension of this move. You can see right here. Also 161% extension of this move right here of this this little flag. Then also it's a 618 retracement of this bigger move right here. From low to high. A 618. So we have a pretty big fib confluence that created this bounce in the dollar, and I think in order for the dollar to continue to rally, we have to see stocks continue to weaken. The dollar, there's not a lot of reasons for the dollar to rally, but if the market becomes fearful of further losses in equities, you might have people turn and sell their equities. And to make it very simple, it's obviously more complicated than this, but they might sell their risk assets or stocks and go back into cash. And going back into cash for most people is going back into the dollar, while the dollar is the reserve currency. So that's why the dollar could benefit even further should stocks move lower. So that's why it's important for us to watch. Now, let me go back over to let's go back over to our home page, and I want to go over a couple of the majors. So let's take a look at the euro dollar. And the euro dollar has had a pretty big rejection from this. This is, if you guys don't know why the 125.30 level was so big, that was a 38% retracement of the, that's not, we're not even showing it here. It's actually close to a 618 of this move, okay, but it's actually a 38% retracement of the highs from 160 that was way up, way outside of this chart, and all the way to the lows. It's actually a 38% retracement. So the euro dollar, for good reason, rejected where it did. I think it's going to be very important to see how the euro dollar reacts at this 121 level. I don't have any dollar positions right now, although I did play the euro to the short side this last week and did, fairly well with it on the way down. I just I'm not really too sure what to do with it right now. I want to see how we respond should we get down to 121, or actually a little bit lower at 120. I think it's 120.80 that's going to be the really important previous resistance, current support, and I want to see how the euro reacts there. The pound also has broken some pretty key support, but is this 138, and let's see if we have it on the weekly chart here. This 138.30 was really important. It was important because it was a 618 on the way up. You can see how it breached it, on the way up. But do you see this low right here? And that was the breakdown point on the night of Brexit. That actually held this week. So as long as we continue to hold above this like 138.30 level, I think it's going to be pretty important for the bulls to hold that. But if the pound actually reverses, because we hit a 786, if we actually reverse and we start coming down to the mid 130s, I mean, we can come all the way back down to the low 130s. There's a lot of unknowns with Brexit, and I think the market might have got a little carried away with itself. Buying up pounds, squeezing some shorts, and we might be in for a little bit of fall, especially if the dollar regains its footing. If the market turns risk off, meaning the stocks continue to move lower, when we have risk quote unquote off, again, the safe haven currency default of choice is going to be the dollar. So the dollar will probably continue to rally as a result of that. Now, let's talk also about like the Aussie dollar. The Aussie dollar, this thing has really come under some pressure. We just about hit the 200-day moving average. It looks like we're going to bounce here. If risk appetite, if stocks bounce, the Aussie could bounce a little bit before reversing. So the Aussie dollar, it's had a heck of a sell-off, but we just came so close to the 200-day moving average. It's already deflected price a little bit, so we might get a continued bounce here in the Aussie. Now, a couple other pairs. Actually, I want to draw something a little bit here on the U.S. dollar Canadian. And by the way, we had Canadian employment data that actually, it was weak data. Weak Canadian data on Friday, but you saw the Canadian dollar actually strengthen following that Canadian jobs report. Why? I think it's because wages were going higher, even though Canada lost way more jobs than the market expected Canada to. The wage inflation that we're seeing in the U.S., it's also being felt in Canada. So what's really important about this Canadian currency is we came out of this descending wedge, but you can see this this previous support that held, and then we had a shooting star on Friday. So in my opinion, the dollar Canadian looks like it's going to pull back a little bit, okay, and before resuming this bounce. And we've got this downtrend line that probably comes into play. By the time we get there, it's going to be around 127, maybe a little bit lower than 127. And I think the Canadian is fairly important to watch as well. And one last one, since I've got it on these live charts, I'm going to take you over to the dollar yen. The dollar yen, really important support coming in play. Let's take a look at this weekly chart. This is a major triangle formation. And you know, a lot of people scoffed at me, didn't get why I was buying yen or shorting the dollar yen when it was up here around the 113, 112 level. And then again, you know, when we came back up again, a lot of people didn't get it. Look, we're in the apex of this wedge, and we're at or triangle rather, and we're at triangle support, and we're really finding some support down there. But the only way, in my opinion, especially now that Kuroda is going to continue to be at the Bank of Japan, so we're not going to see any surprises there with the BOJ. The only way the US dollar Japanese yen is going to break through 108, or probably more importantly like this 107, 50 area, is if stocks come down. But I showed you the S&P already. If stocks do break down, the risk is the US dollar Japanese yen breaks through support. Now, the reason why that's so important is because so many yen pairs, whether it's the euro yen, pound yen, Aussie yen, New Zealand yen, Canadian yen, whatever you're looking at, those yen pairs look extremely vulnerable to more yen strength. If stocks break lower, the dollar yen, the risk is a break below 108. But unless if the S&P continues to hold up above the 200-day moving average, yeah, you could probably continue to be long the dollar yen. We break through the 200-day moving average in the S&P, I would not want to be long any yen pair or short yen. Okay, and I don't have any positions right now, but that's what I'm watching very closely, as I'm also monitoring stocks extremely carefully at this point. All right, guys. Hey, listen, next week we have U.S. inflation data, CPI, producer prices. We also have retail sales on Wednesday here in the U.S. It's going to be really important to see if inflation is continuing to tick higher. But if we can't pull out of this, if we can't see some higher inflation, stock market might not like that. I don't know if the stock market's going to like the fact that inflation is not rising. Also, I guess I should mention that we got to watch bonds. Yields are extremely strong. The dollar has yet to be really responsive to yields to the bond market, but that could change at any given time. A couple other things that are happening this next week. We have Australia employment on Wednesday night or Thursday morning if you're in Australia. Also, we have UK retail sales that are happening on Friday morning. So if you have, and then also actually UK inflation data is going to be Tuesday morning. So if you have any pound exposure, keep that in mind. It's very rare that I actually start the week without any positions, but I'm actually flat going into next week. But there's a lot of exciting things that are happening around the market here, and there's a lot of potential for movements. So to stay on top of everything, make sure you listen to our daily webinars every single morning. Myself and the team, we host a free webinar called the Face webinar. Dale Pinkert is our hostess with the mostest, and he also puts together some great interviews. We have a lot of celebrities that you would see on CNBC. They come in and speak after our hour of analysis, and you get a lot of time with them. So make sure that you're tuning in to those webinars. But if you miss them because you work or you just didn't get an opportunity, make sure you subscribe to this YouTube channel. So just hit that subscription button alone. And guys, if you like this video, make sure you hit the thumbs up button for me. That makes it makes me feel good, and it makes our team feel good, and it makes us feel like we should continue to do these for you guys for free. So guys and gals, my name is Blake Morrow. I'm with Forex Analytics. You've been listening to the week ahead video. Good luck next week. Remember, volatility is high. Make your positions, keep your positions a little smaller to absorb some of that volatility, to reduce your risk, and be careful out there. Have a great trading week. Thanks a lot. Bye-bye.